So my risk statement is life insurers moving towards direct-to-consumer distribution channels may experience an increase in money laundering and terrorist financing transactions. So that's a mouthful, but in other words, if life insurers start selling more life insurance policies on the internet versus in a face-to-face traditional manner, are they going to experience more um, problems with money laundering and terrorist financing? So let's have a little look at a background. Uh, Criminals and terrorist organizations, they're always looking for ways to launder their ill-gotten gains. And one method, believe it or not, is purchasing certain life insurance products, such as cash value life insurance policies and annuities. The Federal Financial Institutions Examination Council has regulations in place, and they actually define certain products, such as permanent life insurance policies, other than group life policies, annuities, other than group annuities, and any other insurance products with features of a cash value investment. A prime example of this type of problem was something that happened a few years back. The U.S. Customs Service had a 2-year investigation known as Operation Capstone. It involved a Colombian drug cartel that was purchasing life insurance policies on their associates. They would then liquidate the policies after holding them for a short period of time, and the beneficiaries, who were their associates, would receive a wire transfer of the proceeds from those policies. Another well-known example, a recent one, is the Paul Manafort case. In that instance, he had laundered funds in many different ways, but he actually also did it through the purchase of a multi-million-dollar life insurance policy. Ironically, he later cashed out that policy to use those funds in part as part of his bail package to get out of jail, at least for a while, when he was arrested. So the traditional distribution channels for the sale of life and annuity products has been marketing through appointed agents. So the life insurance companies will hire or appoint agents to sell their products. And the way that it's generally done is in a face-to-face manner, where the agent will want to meet with the client and present their various product options. It also gives the agent an opportunity to size up that client, or get a better understanding for his or her lifestyle, their financial needs, etc. And if a sale is made for a sizable policy, the next step would be to have a medical exam done by a nurse. So usually what happens is an appointment made, and the nurse will come out to the individual's home and they'll do a medical exam. And while the nurse is there, part of her job is actually to kind of eyeball the home and the lifestyle and so forth, similar to what the agent is doing. And traditionally, the first year's premium for that policy is the agent's commission. Now, in the United States, the U.S. Patriot Act expanded the Bank Secrecy Act's definition of financial institutions that are required to establish compliance programs to include companies that offer the following high-risk covered products. And they are permanent individual life insurance policies, individual annuity contracts, and any other insurance products with cash value or investment features. The compliance programs are required to include written internal policies, procedures and controls, designation of a compliance officer, ongoing employee training, and independent testing of the compliance program. Effective May 2nd, 2006, the U.S. required life insurance companies to report suspicious transactions involving covered products exceeding $5,000. And the government defines suspicious transactions as it pertains to life products as any illegal activities intended to hide or disguise or hide funds, evade the government with no apparent lawful purpose, or to facilitate criminal activity. So traditionally, the life insurance companies would mitigate the risk for money laundering and terrorist financing by utilizing certain triggers. And these triggers included customers who are introduced through non-face-to-face channels, because traditionally they were meeting all of these clients face-to-face. Significant or unexplained geographic distance between the location of the customer and the location of where the product sale took place, because ordinarily the agent and the client would be relatively close to each other. Customers who are reluctant to provide identifying information when they're purchasing a product. Customers where the beneficial owner of the contract isn't known. Customers that are legal persons whose structure makes it difficult to identify the ultimate beneficial owner or beneficiary, for example. Customers who seek or accept a very unfavorable account, policy, or contract provision, which would strike you as being as kind of odd. And ordinarily, an agent would have a conversation with their client and try to figure out, what's going on. Also, customers who transfer the benefit of the product to an apparently unrelated third party. That's another reason that agents like to get to know their customers, because then they also know who their beneficiaries are. Customers who show little concern for the investment performance of a product. That makes sense. But do have a great deal of concern about the early termination features of the product. So that's a red flag. Now, with a direct-to-consumer distribution channel, there was recently a McKinsey study done in 2016 where they found that 35 to 45% of affluent consumers would prefer to complete the process for life insurance quoting and sales actually online. They don't want to deal with an agent on a face-to-face basis. And also, there has been progress made in the technology side of things, and there's now artificial intelligence programs that are used to pull public records such as credit reports, to issue policies quicker and without the need for medical exams. So they've developed other underwriting methodologies, so they don't need these medical exams anymore, which of course eliminates the need for the nurse to show up, but also then they don't have an opportunity to eyeball the client as well. So now there's no more opportunity for the agent in this scenario to establish a relationship with a client with part of the objective of the risk mitigation. So what's the impact of direct-to-consumer distribution on risk mitigation? Well, it's kind of the things we kind of discussed, but in the reverse. So one of the biggest, of course, is triggers would be there's no more face-to-face, since one of the objectives of face-to-face was to kind of scope out the client. That doesn't exist anymore. Geographic distance, that's really not relevant anymore, because the idea is with the internet to reach as many people everywhere, anyhow, anytime that you can. Customers who are reluctant to provide identifying information, that's going to be more challenging in a virtual environment. And customers where the beneficial owner of the contract is not known, that's going to be more difficult as well, because there's no relationship between the client and the agent. There's no agent really. Customers that are legal persons whose structures make it difficult to identify the ultimate beneficial owner, that's going to be murkier, and with the internet. And customers or clients who don't seem to have a problem with unfavorable account or policy contract provisions. I don't even know how they would even ask or inquire about that anymore in this scenario. Customers who transfer the benefit of the product to an unrelated third party, once again, it's going to be more difficult to determine who is related or unrelated. And customers who show little concern for the investment performance. I don't even know if they're going to be able to tell if someone's concerned or not concerned going forward. So I started to do a risk analysis on this and looked for some information. One of the things I was able to find through the Insurance Information Institute was a sales trend with the industry, life industry. And from 2007 to 2016, there was an increase in direct-to-consumer sales of individual life policies from around 2% to around 9%. So I thought that was an important piece of data to have. Um, However, it should be noted that there's no, or I couldn't find any money laundering or terrorist financing life insurance statistical data out there. I was able to look for some other type of data, though, from a criminal standpoint, and there's a Price Waterhouse Coopers study that was done in 2018 that showed that reported economic crime in the United States had increased from 37% in 2016 to 54% in 2018. Also, interesting, the life insurance industry is using what's referred to as a qualitative risk rating model with quantitative weighting and scores, and the range they set it up as high, medium, and low to try to sort out these attributes that I previously discussed. The non-face-to-face, the geographic distance, etc. I put a little example here in the PowerPoint slide. And they do a weighted score and they come up with a final score. But as we learned through this course of enterprise risk management, that doesn't contain everything. So in my opinion, they really aren't looking at everything in its totality. So I believe the following factors, in addition to what is being looked at, should be considered when doing this type of analysis, and that would include the financial risk, the strategic risk, and the operational risk. So additional factors that I included in the financial risk would be pricing changes of whole life and annuity products, and they do change based upon mortality tables. It impacts the premium pricing, external competition, pricing changes, and as we learned in this course, that risk goes both ways, not just down but up. Upside risk advantage of increased revenue, but not having to pay sales commission anymore on these direct-to-consumer sales. They don't have an agent to pay. The strategic risk factors would include, as I refer to it, throttling of migration to the direct-to-consumer sales channel and its impact on overall sales, and the acquisition of reinsurance. Reinsurance is nothing more than the insurance company buying insurance to cover their risks of the policies that they're issuing. So basically, they're spreading out the risk. And also there's the operational risk factors, which include, I believe, the probability of unexpected regulatory changes in the direct-to-consumer channel, an impact of the pace of technological advancements that could occur, and also any potential black swan type event, even though I personally think it might be pretty small in this instance. Also, we have to keep in mind the risk appetite for an insurer that wants to move into this the sales channel and what it might bring their organization. So then I'm looking at the sources of data. There isn't a whole lot of publicly available data, but I did review some already in this presentation. The increase in individual life insurance sales, the economic crime statistics, and that aggregate score model. I think that would be helpful. What would be preferable, especially if we were doing a risk analysis on a particular life insurer, would be to get their actual sales data, if they have any statistics on any money laundering or terrorist financing, where they had gotten hit specifically, and also final scoring from any qualitative risk rating modeling that they may have done involving this type of crime. In addition to that, I believe that the following data or considerations are needed in order to do a complete analysis. And they include the considerations of the internal pricing changes of whole life and annuity products, the external competitive pricing, increased revenue, not having to pay the sales commission, how quickly the migration may occur over to the direct-to-consumer sales channel, acquisition of reinsurance, the probability of any regulatory changes, technological advances, the black swan type events, and the company's risk appetite. So after looking at all that, I then was have to determine what type of analysis tool I thought would be best for this. So for presenting this to a bunch of corporate executives, I believe, and they're not risk managers and not statisticians, I believe that probably the best way to present it would be using an influence diagram, because it's going to be a graphical type representation and analysis, of this enterprise risk management. And it will, I think, clearly illustrate the uncertainties and how they influence each other, and also show the potential outcomes. The variables, there's going to be, quite a few of those. It'll demonstrate those in a range. Some of those are going to be determined by the actual, say, insurance company that's being analyzed. By their decision makers will set those ranges. And some are controlled by outside influences. Those variables are going to be represented by deterministic nodes within the diagram. We learned about that in this course, what those are. And I believe visually it's not going to be too complex, because we're going to kind of keep the amount of data, within reason, so it won't be overwhelming. So in conclusion, the old techniques that the life insurance carriers have been using to mitigate the money laundering and terrorist financing risk may not be applicable in this new environment. The evolution into the sales channel and potential risk should be analyzed, certainly from an enterprise risk management approach versus the approach that I found that they were doing. The problem is the life insurers tend to keep their internal data away from the public, probably because they don't want their competition to see it, other than what they're forced to show by the regulators, or if they're a stock company, in their financial statements. And in order to accurately and complete the analysis, it's going to require their participation and cooperation, which I would assume you would get if we're undergoing an analysis upon, say, their request. And lastly, you could easily jump to a conclusion just looking at the data that is available that, oh gosh, if they're going to start selling on the internet, then certainly they're going to have more problems with money laundering. But I don't think that one should assume that that's going to be the outcome without doing a complete, thorough enterprise risk management analysis on this topic. So I appreciate the time you took to listen to my presentation. Thank you.